gentlemen, good morning. Whilst my fellow panellists are receiving their mics, just a few words of introduction. Very warm welcome to everybody here to this plenary session on how the end of QE may or may not impact on pensions. So an incredibly topical subject. Also, I should say, welcome to everybody that is watching online. This session is being live streamed, and for those people both in the audience and online, they are able to ask a question via the app, which we will endeavour to take at the end. I'm delighted to be joined by three experienced panellists. On my far right, Professor David Miles, Professor of Financial Economics at Imperial College and a former member of the Bank of England MPC. So be very interested to hear from David on QE. Next to David, Robert Waugh, Chief Executive and Chief Investment Officer of the Royal Bank of Scotland Pension Scheme. And last but not least, Greene, who's Chief Economist at John Hancock Financial Services and Manulife Asset Management. The structure of this session will be that each of the panellists will make some opening remarks. I will then use my chairman's prerogative to ask some questions of the panel, and then we'll go into a Q&A session either online or the way in which I quite like doing it, which is stick your hand up and ask a question, okay? So there will be time for questions at the end. So if I could ask David to kick off, and David's going to essentially set the scene for us and explain QE in a way that everybody can understand it. So I'm looking forward to it, David. Thank you.
Thank you very much. I've got a few slides. This will not be death by PowerPoint. My aim is to speak for 5 minutes and no more than 5 minutes. That's a picture which shows the evolution of the Bank of England's balance sheet. I joined the Monetary Policy Committee just before that sort of the orangey bit, which is the holding of gilts, began to explode. So asset purchases began, coinciding with my joining the Monetary Policy Committee, as it happens. And you can see why, given the scale of that expansion, and that's purchases, QE has been overwhelmingly about purchases of gilts in the UK. The Bank of England's bought a few other things. Basically, of the 435 billion purchased to date, something north of 400 billion has been gilts. And that massive expansion of the Bank of England's balance sheet coincided with sort of the latest lurch down in yields on gilts. I don't need to tell anybody in this room how low those yields are, particularly on index-linked bonds. So you can see why it's natural to draw a link between the expansion of the Bank of England's balance sheet, and the same thing pretty much happened at the Fed and more recently at the ECB, and extraordinarily low yields. And indeed, of course, those of us on the committee at the time thought that that was a mechanism we wanted to play out. In particular, what I think we wanted to happen, and why I voted for QE while I was on the committee, was not so much to bring down gilt yields. It was much more to bring down interest rates that are relevant to the private sector. The private sector doesn't borrow gilt yields. Corporate bond yields were something that concerned us enormously on the Monetary Policy Committee early in 2009, when, as you will all remember, corporate bond yields had increased enormously relative to gilts. And actually the strategy, as I saw it, was to buy gilts, hoover them up in some sense, and encourage the people that sold the gilts to us, the Bank of England, to look for something that was a substitute for gilts. And a sterling corporate bond we hoped would be a close-ish substitute, and therefore you might bring down corporate bond yields. And as it happened, corporate bond yields, as you all know, came down very dramatically during the course of 2009 and into 2010, which was when the bank was hoovering up most of those gilts. The scale of the operation is extraordinary, of course. By early 2011, 2012, the bank had bought about 30% or 25 to 30% of all the outstanding gilts, and still holds all the gilts, essentially all the gilts that it bought back then. So it's natural to think that this process was a major factor behind bringing down gilt yields, and therefore the question is, well, what happens when it gets reversed? And let me offer a few thoughts on those. The first is that I do think that the purchase of assets did have a substantial impact at the point at which financial markets were at their least well-functioning or most dysfunctional, which probably was early 2009 and through 2009 going into 2010. And it probably had its biggest impact, I suspect, in the corporate bond market more than it did in the gilt market. I suspect, and it's a view I took when I was on the committee, that once financial markets were operating a bit more normally, were not dysfunctional, that actually further purchases would have a much reduced impact. And I suspect that the latest round of purchases by the Bank of England have had much less of an impact than those purchases, for example, particularly in 2009 and into 2010. I think the bigger story, and the main point I want to make actually, is that whatever impact asset purchases by the Bank of England, by the ECB, by the Fed, by the Bank of Japan, whatever impact they may have had on interest rates, and particularly longer-term real interest rates, whatever impact they have had, it actually isn't the main story behind extraordinarily low real rates. I'm sure people have seen charts like this before. This is a chart of the index-linked bond, longer dated, I mean actually not that long in some countries because they don't issue that much very long-term stuff, but it's sort of longer, at least over 5 years maturity, yields on index-linked bonds, and the chart kind of speaks for itself. It's been on a downward trend for about 20 odd years. In fact, I think the downward trend starts earlier than that. And if you look at that chart, you wouldn't really pick out, in particular, 2009-10 as being a discontinuity in that chart. I think a better chart in some way. This is an attempt to sort of cobble together from various sources, both conventional and index-linked bonds, a measure of the what you might call the global real yield on longer dated bonds, basically drawing on government bond yields adjusted for inflation and where they exist, and there's a deepish market, index-linked inflation-proof bond yields. And I think you can see once again a trend that starts, I mean, at least 30 years ago, probably in the mid-80s, not even the late 1980s. And once again, if you looked at that chart, one wouldn't pick out 2009-10 and say something happened then which was off the scale relative to history. So there's something much bigger, I think, behind the phenomenon of extraordinary low interest rates. My own view, for what it's worth, is that the dramatic growth in countries that have a very high savings rate, and in particular China, has coincided with a long-term reduction in the necessity for the corporate sector to invest as much in big, heavy capital goods that they used to. We no longer have such investment in shipbuilding and in the steel sector. Heavy industry doesn't need as much, or GDP doesn't need as much heavy scale investment as it used to need. And if you have a period, a long period, 30, 40 years, of the savings rate globally tending to go up and the demand for investment, physical capital investment going down, and you think of the interest rate as the price that equates savings and investment, you get a declining real interest rate over a long period and potentially by a very substantial amount. And my own view, for what it's worth, is that QE is a little bit of a sideshow in all that, and that therefore, if QE does get unwound, I suspect it won't take real interest rates back up to what we might have thought was a normal level 5, 10, 15, 20 years ago. Final point, and then I'll stop. I'm not sure that QE will be unwound, not in the UK. And let me just show you one final chart to illustrate why that might not happen. This is a chart which shows the holdings by the banking sector in the UK of very liquid assets. And I want to focus in particular on, I think it's the middle line, which is the line called the reserve ratio. That is the holdings by the UK banking sector, basically, of reserves at the Bank of England. Super safe, highly liquid, they can draw on them when there's a problem. Until we get into the financial crisis, most banks thought they didn't really need to hold that stuff. If one bank was short of money, they could borrow from another bank in the interbank market. What could possibly go wrong in the interbank market? Okay, after the interbank market stops working, most banks, I think, reckon that they probably want to hold a lot of reserves at the Bank of England just in case they get into a situation where they can't borrow from other banks. Let's suppose they want to do that. Reserves held by the banking system at the Bank of England is the counterpart, it's the other side of the balance sheet, to the enormous expansion in gilts held by the Bank of England. That's why that line ticks up significantly after about 2008, right at the end there. It used to be the case, before the crisis, the total amount of reserves held by the banking system at the Bank of England was about 25 billion. It's now about 350 billion, probably nearer 400 billion, come to think on it. Let's suppose that banks now think that's a prudent level of super liquid, safe stuff to hold at the Bank of England. And they don't want to get rid of that. That's the new normal for them. They don't want to go back to where they were in 2007, 2008. If that is true, and I suspect it might be true, if that is true, the Bank of England balance sheet will be much bigger, virtually permanently. What assets does the Bank of England want to hold against sterling liabilities that pay interest, which is what reserves are? Answer, probably gilts. Maybe they'll be slightly lower maturity than the gilts they hold at the minute, but I suspect that the Bank of England balance sheet will remain very big for rather a long time, and that they won't be, in a meaningful sense, a complete reversal of QE. There may only be a very partial reversal of QE. So even if you thought that asset purchases were a major factor behind the drive down in real interest rates, I suspect they're not going to be reversed on any substantial scale anyway, at least in the UK. I will stop.
David, thank you very much for that.
Leave that up, mate.
Thank you very much. So thank you for that, for those opening remarks, sort of setting the scene in terms of what's been happening. If I could ask Megan now just to perhaps talk a bit about how she sees the outlook, what's going on in Europe, what's going on in the US, views on rates, I think that would be very helpful.
Yeah, sure. So thank you. There are disparate narratives for the Eurozone versus the UK versus the US, but I'm going to try to get through them in 7 minutes. Just starting with the UK, in terms of rates, the Bank of England is in an absolutely unenviable position where it's stuck between looking at growth, which isn't looking great, and looking at inflation, which is actually looking pretty robust. And I have to say the UK is the only developed country that's actually managing to get any kind of inflation. So in that way only, it's the envy of lots of other developed economies, but only in that way. And so the Bank of England has to choose between whether it's going to support growth or tamp down on inflation. In the past, when it's been faced with this choice, for example, during the financial crisis, the Bank of England erred towards the side of growth, so they were supporting growth without worrying too much about inflation. It seems like this time around, they might actually be looking more at inflation. So we've had a lot of hawkish talk coming out of the Bank of England from Mark Carney, Andy Haldane, and I do think pretty robust wage growth actually paves the way for the Bank of England to go ahead and hike rates in May. Now, the Bank of England has suggested they'll hike rates by at least 3 times over the next 3 years, hopefully more, and that seems to be priced into the markets. I actually don't think that's going to happen. I think the Bank of England is going to have a hard time hiking after this May, based on economic indicators, which are largely turning, except for the employment data, which continues to look really good in the UK. But employment is a lagging economic indicator, so I'd say just wait for that to turn around. So at the short end of the yield curve, I think probably too much is priced in, and so that we might see that change as markets come around, if I'm right about this. So what will happen at the long end of the yield curve? Well, 3 months ago, the OBR revised its borrowing down for 2017, 2018 off the back of better than expected economic growth. So that's a good thing, but if you just look at really simple supply and demand, so the supply will be smaller. I don't have to tell this room that the demand for long-dated paper is really robust. So if you have the supply shift in, demand remain really strong, then prices go up and yields go down. So even if the short end of the curve might drop a little bit, I think that the long end might as well. So unfortunately, we're stuck with a pretty flat yield curve. I don't really see that changing anytime soon in the UK. And one way we could change that is to have absolutely terrible economic data so that the OBR has to revise those forecasts up so that there's more borrowing. Maybe you could see yields go up, but not for a good reason. So I think the yield curve in the UK will probably stay pretty flat. And I would agree with David that the UK is stuck in on QE. They might, stop buying things, but they probably won't engage in quantitative tightening for years to come, if at all. And there is no actual economic or financial reason to shrink your balance sheet as a central bank. The Fed's doing it for political reasons. They don't want to be under the Treasury's thumb. And so I'll switch gears onto the US a little bit. I'm based in the US. We're absolutely obsessed with inflation right now. Everyone's really up in arms or excited about this so-called late cycle surge in inflation, which you would normally get at this stage in an economic recovery. The thing is, the business cycle is so much longer now than it ever has been because central banks keep stepping in and goosing the system that I think this late stage of the business cycle can last for a really long time. So I don't actually buy it that we're getting this new surge of inflation in the US. It's not coming out of left field. There are some things that are pushing inflation up, like commodity prices, fiscal stimulus. We had 1 month of good average hourly earnings in the US, which is part of what prompted this market correction that we had in late January, early February. If you look at that average hourly earnings number, it's just earnings divided by hours, and the number of hours fell. So if you reduce the denominator of any ratio, the overall number will go up. So it's no surprise that that number was really good. It's not clear that that will be sustained. We'll find out on Friday, actually, when we get our next report. We have, a bunch of stimulus measures coming down the line in the U.S. that some argue might be inflationary. If you look at just the supply and demand curve again, there are two positive supply side shocks in the U.S., the tax bill and deregulation. And there's one negative demand effect, which is the Fed withdrawing some of its accommodation by shrinking its balance sheet. All of that is disinflationary. So all of that will offset these inflationary pressures I've talked about. And then you have a few factors that actually don't just affect the US, they affect the entire developed world. So we've got a demographics shift. There's a massive oversupply of cheap labor globally that keeps upward pressure off of wages. Most of what we consume in the developed world, about 2/3, is services now. It used to be goods back in the 1950s. Well, services sectors are really low-wage sectors, so it makes sense we're adding all our jobs in the sectors that are producing what we're consuming, but that means we're adding all our jobs kind of at or slightly above minimum wage. So that keeps upward pressure off of wages and therefore inflation as well. So I think there are a bunch of disinflationary factors in the US economy that most people are actually overlooking, and I think that they will largely offset the inflationary factors. So we'll get some modest acceleration of inflation, but not this late cycle surge that some people are excited about. So I think we'll end up having 3 rate hikes in the US by the Fed. There is a question about the implications of quantitative tightening on all of this. Some people are worried that as the Fed starts shrinking its balance sheet, there's going to be a demand problem. So who's going to buy up all of these treasuries? In my view, there are very few safe haven assets out there, and most of them are US dollar denominated. Maybe German bonds as well, but they're yielding so low that they're not as attractive. So I think there's an insatiable demand for US treasuries. And so I don't think this will be a problem. I think 10-year yields will probably get up to 3.25 maybe, which is just nothing to write home about. There's also a question about, when we had QE, everyone was really worried about inflation. We didn't get inflation, in prices at least. We got inflation in asset classes. And so why, if you do the reverse of that, if you start shrinking the balance sheet, why won't asset prices fall? The Fed will argue it's because QE involves shock and awe, and it was all done at once, whereas as we're going the opposite direction. They've signposted it really clearly. They've put it on autopilot. Everybody knows about it, so the market implications will be smaller. There might be some validity to that argument, but I do think there's a lot of risk involved there. And then finally, just really quickly, the ECB, they actually have their Governing Council meetings is right now. They'll be announcing forecasts and potentially some changes in forward guidance later today. Inflation's 1.2% in the Eurozone. It's supposed to be close to, but just below 2%. So like every other major central bank, they're missing their inflation targets pretty significantly. German wage growth seems like it might be stronger. So a really big, influential trade union, IG Metall, managed to negotiate pretty big wage gains, and they tend to set the standard for the other unions. So that could push wages up a little bit. Though again, I don't think it's really a game changer. I think probably the ECB will end QE in September, and we'll try to get rate hikes in starting at the end of the first quarter next year. That's not because they're hitting their inflation targets. But the one thing that I think actually combines all of these narratives I just told is all these central banks are desperate to get rates up so that they can cut them one day when the next recession comes. On average, Western central banks cut rates by 500 basis points in the face of a recession. Nobody has room to do that at this point. So central banks are trying to get rates up. It does leave a question about what our tools are in the next recession, and you have to think the next recession must be coming in the next couple of years. I guess central banks will be able to cut rates a little bit because they're off the floor. They will be off the floor by then. But there's a good chance we'll have to fire up QE once again, and I agree with David that each successive round of QE that you have is a little bit less effective. So we know central banks will step in. Will it really help? I think that's a question that remains. So I'll leave it there.
Good, thank you very much, Megan, for those remarks. Thank you. So over to you, Robert, to perhaps talk about the impact on schemes and your thoughts on the impact of unwinding of QE, hedging, all that kind of stuff.
Yes, thanks, Robert, and good morning, everyone. My role on this panel is to talk about QE from a pension fund perspective, because I have no intention in competing on economics with my two fellow panel members. In recognition of International Women's Day, I have included pertinent quotes only from women in my speech this morning. So I want to start with common misconceptions, two of which were included in the title of the talk today. And the first is that QE is ending. So from a pension fund perspective, there are two major influences from QE. The first is from global QE creating more liquidity in markets, which has pushed up asset prices. And there's no sign of that reversing, as in quantitative tightening on a global basis by all central banks. And then the second effect is the effect on our discount rates caused by UK gilt yields. And that's obviously more influenced by UK quantitative easing than global quantitative easing. So the second misconception is that quantitative easing has been bad for pension funds, and it's a nice story to have out there for us all, someone else to blame. But actually, in reality, if we go back to 2009 and look at the Purple Book, and we look at the sensitivities in there, we can work out that the 2.5% reduction in real rates in the UK has added about £500 billion to our pension liabilities. The movement in our assets since then has added about £400 billion. So we're about £100 billion worse off as an industry, or about an 8% increase in our deficits. But what's the counterfactual? What if we hadn't had QE? Suppose we'd had disinflation. Disinflation is probably the worst scenario for our pension funds. We may have well had rates where they are today anyway, but we may have had rates where they are without the growth on the asset side of the balance sheet. And then think about our covenants. Since the PPF was set up, 1,000 companies out of 6,000 have gone into it. How many would that have been if we'd had a disinflationary or a depression scenario in the UK? Would the PPF have been able to survive that scenario? It was a much smaller base of assets back in 2009 than it is today. One of the amusing things is that a lot of people put the argument out there that QE has forced people to sell gilts and move up the risk curve. And of course, if you read back to the early Bank of England papers, that was one of the intentions. And yet UK pension funds have not done that. If we go back to 2009, UK pension funds had 37% in fixed interest assets. They now have 56%. They had 12% in index-linked bonds. They now have 26%. So it's had the inverse effect. What's happened is, as rates has fallen, as we all know, our deficits have got larger. We've worried about our risk. We've had to hedge more. We've bought more gilts. We've forced the price down further, hence increasing our deficits, and so on and so forth. And then there's the unintended consequences of quantitative easing. On pension funds, we've seen a huge reduction in active members from 3.6 million to 1.3 million, probably faster than we would have seen without QE. We've seen an enormous increase in transfers out. Now, obviously, a large factor of that's freedom and choice, but with interest rates as low as they are and pots of money looking very attractive, that must have had some effect. Sponsors have had to contribute more, and it amuses me slightly. I was suggesting to David one of the unintended consequences of QE, a lot of his colleagues are on strike at the moment. And then there's the effect on society, and Nick Clegg touched on this yesterday. QE was to some extent a counterweight to austerity. The elite got significantly wealthier, but not because they'd invented anything, not because of an increase in innovation, not because of an increase in productive capacity, just because they happened to own assets. Christine Lagarde commented on inequality, distrust, and a lack of hope are fueling growing populism. So maybe QE created Brexit. And QE, in many senses, broke the social contract. Rachel Lomax said, it's a stealth tax on savers. And whilst possibly helping to avoid deflation, it's actually not helped productivity at all. So the growth we've had, we could argue, is not good growth. It's not growth driven by investment, and it's not growth driven by productivity, so people have not got better off. As Kate Barker put it, we're not spending money in the real economy. And in the US, David is right, corporate bonds yields have fallen dramatically. Companies have issued a lot more corporate bonds, but what have they done with that money? They've bought back stock. They've not invested in the economy. So there's been a moral hazard in bailing out companies and individuals who were levered, and we've prevented perhaps some of the creative destruction that might have happened to put us in a stronger footing coming out the other side. So what should those of us do who are trusted to manage pension funds? So for this I have to ask a question. How many central bankers does it take to change a light bulb? The answer is just one. He or she holds it, and the whole earth revolves around them. And in many senses, that is the problem for us today in trying to predict interest rates. They're no longer driven by free markets. We can't just analyse the economics and come to a conclusion because they're now actually driven by this central banking party. And let's be honest, the pension industry has not been particularly good at predicting interest rates anyway. If it were that easy, we would have all hedged when quantitative easing started. So I'm going to quote from Game of Thrones. It's important not to believe something just because you want it to be true. Relying on higher long-term rates through quantitative tightening is not an answer to solving your pension fund questions.
Thank you, Will. Thank you very much. Well, thank you very much to all the panellists with some, I think from everybody, a different perspective and some fascinating remarks. I have a couple of questions, but they are linked to some questions we've actually had on the app. But I have one for David, but Megan and Robert, I'm sure will have views. You talked about the decline in real interest rates, David, over a long period of time. And one of the questions that pretty much everybody is thinking about, but I'm not sure there are any easy answers, is there a natural rate of real interest? Is there an equilibrium rate of R star or not?
Let me give you a simplistic answer, which I think is nonetheless helpful in thinking through that profoundly important economic question. So for the world as a whole, since we don't trade with outer space, we have to finance all investment by savings. So for the world as a whole, aggregate saving and aggregate investment have got to be equal. If we traded with Mars, they wouldn't have to be equal. We could run a balance of payments with the outer space, but we don't do that. So what happens when, over a period starting maybe in the early 90s, some bits of the world that happen to have extraordinarily high savings rates become better integrated in the world economy? I'm thinking about China. I mentioned it a little bit earlier. That means that the overall quantity of savings at any particular real rate of return for the world as a whole that's available for world investment is higher than it was. It was constrained to be just in China before. Now they're entering the global capital market. But there isn't simultaneously a global increase of the same magnitude in the total demand of the corporate sector and the household sector to invest at any particular real interest rate. Therefore, the supply curve of savings has shifted to the right. The demand curve for savings hasn't moved. The price is going to decline. And it can keep declining as long as that flow of savings each year is a little bit bigger than it was the year before. And with China growing at the rate it's been growing, that has been what's happening. So then you come to the question, well, so where's the equilibrium? Well, An economist would say this, wouldn't they? The equilibrium is where those two curves intersect and the savings equals investment. And it's going to be a very much lower level as a result of global savings rates in bits of the world that didn't used to matter but now matter a lot, being a lot higher. So where do you reach the equilibrium? Well, I think it's probably at a real interest rate that might be close to a longer-term real interest rate that might be pretty close to zero now, a number that used to be 4 or 5 maybe in the mid-1980s. Is that going to reverse any time soon? Well, if, of course, we get a reversal of those very high savings rates from some parts of the world that have become very important, well, yes, it would. Is that likely to happen? Who knows, but I don't see any obvious sign of it in the near future.
Okay, thank you, David. A horrible question, I'm sorry. I just wondered whether Megan or Robert had any views on that subject.
Yeah, so Jim Bullard from the Fed just did a huge study on this, and he calls it R dagger instead of R star just to differentiate himself. But what he found, there were kind of 3 inputs into what this natural rate is. And one is productivity growth, and that's been incredibly lackluster across the developed world and probably won't change unless we get some kind of massive technological advancement like artificial intelligence coming down the line, not here yet. So productivity growth is low, not changing. Labor force growth is another input. That's also falling pretty significantly in the US, actually growing in parts of Europe, so that could boost the natural rate. But the final one, which actually has the most salience here, is demand for safe haven assets. And that's part of what David's getting at with demand coming from emerging markets. They're growing much faster than the developed world, so they're providing some demand. But guess what? Central banks are providing a whole lot of demand for safe haven assets as well. So as they're withdrawing that might fall. So the idea is which one will come out ahead? Will growth of emerging markets push these natural rates up, or will the withdrawal of monetary accommodation actually push it down? Central banks are hoping that the former will outweigh the latter. It still remains to be seen, though.
Okay, thank you. I'll come back to a comment. I'll come back to one of your comments in a moment about safe haven assets in the US. But one for Robert, actually. In terms of QE, effectively, do you think that the impact of QE has sort of raised prices of all assets and reduced returns? Where are you on the impact of that?
So I can't prove causal effect, but the expected return in nominal senses of all assets we invest in, be it corporate bonds where we've got a fairly good idea of the return through to private market transactions, has probably come down on average by 200 basis points through QE, but real rates have come down by 250 basis points, so our spread above risk-free hasn't moved. If our liabilities are being measured off risk-free, it doesn't matter to us because we've got an asset liability issue, but our nominals have come down.
Yeah, okay. Megan, just going back to safe haven assets, you made some comments about the US being a safe haven. I hesitate to mention politics on this panel, but do you, again, you're talking from a US perspective, but any doubts about the fact that US Treasury could cease to be a safe haven at some stage?
At some stage, maybe, several decades from now. At the end of the day, the US has the biggest, most liquid asset class in the world, the Treasury market, and we have the global reserve currency. And so on that front, some American exceptionalism probably is justified. So, I don't think we're going to face the kind of investment strike that Europe faced, for example, in 2010. So we will benefit from that. I don't think the policies of one administration will raise enough alarm, whatever they are, so that the US isn't considered a safe haven asset. And if you're an investor, gilts used to be a safe haven asset. Well, now we've got Brexit, so not really. You had JGBs, but the Bank of Japan controls the entire yield curve now, so you can't play along that. Maybe German bunds, but they're so incredibly low yielding that the only game in town really is US dollar denominated assets.
Okay.
And things like Bitcoin, if you ask a millennial, what could possibly go wrong?
Yeah, Bitcoin reminds me, well, I had an incident in our local village store recently, about 3 months ago, when the chap behind the counter started asking me about Bitcoin. I decided this was definitely a bubble. Anyway, That's a side point. I'm just going to switch now just to some questions we've had from on the app, and it I think linked to some comments that everybody's made, but particularly David and Megan, which is Bank of England saying last week there was a negative impact of QE on corporates, and one of the problems that we're seeing is the lack of investment, the lack of physical investment. That's partly, I guess, because the world is kind of changing. We're going from making physical stuff to doing other things. But any thoughts on what we could do to increase or improve investment in the real economy?
I can pick this up quickly. I think this has been a capex-less recovery in the developed world, and I think there are two main reasons for it. One is just labor is so incredibly cheap globally that why would you buy a really expensive machine that you have to use for years and years to justify it when you can just hire a bunch of super cheap workers and lay them off whenever you want. So labor kind of is the new capital, and that will be the case until wages go up, and they are going up in the UK actually, but probably for the wrong reasons. That's one reason. The other reason is that the C-suite often pays themselves in options grants that are out of the money until you engage in stock buybacks, and then they're in the money. You can pocket the proceeds, wash, rinse, repeat. So this is a cynical view, admittedly, but instead of using profits for investment, often they're used for buybacks, which we've seen in the UK and the US, and I don't see that changing anytime. Maybe if equity markets get so incredibly overblown that it doesn't make sense to be goosing your stock price anymore, then that will slow down. But that's about all that would change that.
Yeah, it reminds me of the old Charlie Munger adage, show me the incentives and I'll show you the results, right? Yeah. Rob, any inputs?
So I think this is, as my friend Bill Priest would say, that atoms have been replaced by bits. And, I was in France last week, and if I wanted to read the FT, I picked up my phone and I clicked on it. Whereas if you think about the infrastructure that used to have to be in place to print that FT with the printers and the machines and then transport it overseas through a wholesaler into a retailer, that's all gone, yeah? So you've still got about 20% of the staff there who are writing the paper and doing that. The other is the same if I wanted to watch a movie in France. I clicked on Netflix, download a movie, plug the phone into the TV. I don't have to go and buy a DVD that's been printed, that's been distributed, that's been retailed. And this has just taken out a vast swathe of capital that it was needed in society. And it's, I think, easy to underestimate the effect of the changes in technology on this whole investment cycle. But it's very hard, equally, to analyse it in numerical terms.
Mm-hmm. David? I strongly agree with what Robert just said. I think GDP in many developed economies, including this one, is just less capital intensive than it used to be. And a lot of GDP is not so much physical heavy stuff anymore. It's almost weightless. In fact, some economists, I think Diane Coyle, a very good economist, suggested that if you worked out what is the weight of UK GDP, the physical weight of GDP, not its money value, but its weight, it weighs the same now as it did about 30 years ago, and yet GDP is dramatically higher.
Okay, good. Just to deal with a couple of other quick questions before we open up to the audience. Question, how confident is the panel we've seen the end of QE over the medium term? Will we see it again?
Well, I'm not confident at all. I think QE is a bit like fire. It's fine if you have it in a small area, you can warm yourself up and it has some purpose. But if you put it in the wrong hands or you let it get out of control, you get seriously burnt. What worries me is it's fine as long as we've got central bankers controlling QE. If we get politicians controlling QE, we could have a different outcome.
Yeah, so we'll absolutely see QE again. There's no doubt about that. In fact, we might see it in an even more extreme form that you've just referred to, which is kind of helicopter money. I think as developed economies, we haven't worked out exactly what a sustainable growth model looks like. Mainly we just leverage up, and that's what this recovery has been all about. That's what the last one was all about too. There is an oversupply of debt. We're going to have to pay for it somehow or write it down. I don't know how we could have some kind of default that's managed. I think it'll just all be monetized away.
Right, and a final question from the app. I think probably to Robert, actually. Is gold not the ultimate safe haven asset?
I don't think we've really got time to answer that.
Not
probably not, though it would appear to be.
Okay.
It has no intrinsic worth, so only like fiat money, it only has a worth because people believe it has a worth.
Okay. Fine. I'm just going to. We're nearly out of time, but for those of you that are technologically challenged like me and couldn't get the app to download, I just want to check whether there are any burning questions from folks in the room before we wind up.
There's one middle.
Yeah, there's a yeah, John. Sorry, I couldn't see you. You're behind the monitor. I'm sorry. And I didn't have my glasses on.
Not an issue. Megan, you briefly mentioned the word Bitcoin. On a more serious basis, what impact is crypto going to have on fiat and on the deregulated sector, because it's outside of regulation?
Yeah, so the technology behind Bitcoin no doubt will have transformative properties for the entire financial services industry. As a currency, I don't believe in Bitcoin at all. There's nothing backing it up. There's no one who can print it. If there's a run on Bitcoin, you can't go shove Bitcoin in a bank window to prove that actually the system is stable. It's based on fumes, I think. So I'm not buying it as an actual currency. Was there a follow-up?
I didn't say Bitcoin, I said crypto.
Oh, cryptocurrencies. All right, well, Bitcoin is one example, but I think the same analysis goes for any other cryptocurrencies.
Okay, there's a gentleman in about the fifth row back. We're just going to quickly take that. I've got a fantastic question on the app, but it's so complicated and so intense, I don't think we're going to get time to do it. Another time, perhaps. The gentleman there.
George Graham, a trustee. One of the arguable consequences of QE has been that a number of zombie-type companies have managed to remain in existence. Are we likely to see increased stress on sponsor covenants as QE is gradually withdrawn, or at any rate ceases to provide active upward impulse?
Impact on sponsor covenants and corporates. Any views? Megan, Rob?
We should do, because rates are going to go up at the same time most likely, so they'll have a harder time servicing their debt at the same time that demand's been withdrawn.
So I think yes, because rates go up, but the reason we're not going to get a reversal of QE is because there's so much debt left in society that we can't actually sustain higher rates. So when rates go up, we'll find a slowdown in growth, and therefore actually rates won't go up further. And we're kind of in a catch-22 and the level of debt we've got.
Okay, fantastic. Right, I think sadly we are out of time, so thank you everybody for attending, thank you for our speakers. Please, if you have the app, please rate the panel on the app. We're now going to move into a refreshment break in the exhibition area. There's a learning hub going on about European private debt, and there's also open PLSA. So if I could ask you to thank the speakers in the normal way, thank you very much.